Christopher Peel, Chief Investment Officer at Tavistock Investments. Good morning to you, sir. And Chris Wiley is with us as guest host, Chief Investment Officer of Connaught Broadley Wealth Management. Well, let's just talk about where we're at in these markets. What are the opportunities and what are the pitfalls at the moment? Christopher, you've got an October 2019 market notes piece, which I have in front of me as well. How much of it is dominated by political events in Europe?
Well, my lead paragraph is all about Brexit. That's certainly the focus of the day. Lot of water to go into the bridge this week to see whether or not Johnson can reach some type of revised agreement with the EU over the Irish backstop. I think that's the main focal point, because it also has huge ramifications on the EU economy itself, given that parts of it, specifically Germany, is already is nearing recession, if not in recession. They can't afford to lose access to the UK market.
So are we off to the races on the upside on, I mean, there's just two countries you mentioned there, the DAX and the FTSE, if we get a Brexit deal, or will it be a false dawn, given the fact that the reason why the German market is challenged, and we've discussed this already in the show, is not actually that much to do with Brexit?
Well, the thing is, the German economy is really suffering with the change in the way the car manufacturers are trading around the world. There's maybe been a lag in the move to using electricity, but in terms of the UK market, is cheap. Certainly the mid-cap space, it's been cheap for for quite a few years now. I'm not so sure it's right to just jump in here, because until you see the shape of the trading relationship, it could be very premature to say that the UK is going to all of a sudden trade back to fair value. But certainly the UK market is looking attractive on a worldwide basis.
So, Chris, what would you be looking for then as that catalyst, that moment when you think this undervalued situation in the UK is now one to be played? Because, I mean, you mentioned the trading relationship, but it could be a very long time before we see that. Is there anything you can identify nearer term which would persuade you to move back into UK mid-cap?
Well, I think the danger zone is looking at the currency. Currency's now moved quite a long way from 119 and change to 127. That will obviously have repercussions on the subset of the UK equity market that is exporting. But looking at the mid-cap space, PE ratios are very attractive historically, and then also in comparison to other markets on the continent and elsewhere in the world. But I'd rather play it through the FX. I have more confidence that there was a bigger short in sterling entering this final phase than in the equity market.
Just to go into that one more, is it against the dollar, is it against the euro, or is it just not matter? Just you can buy it against anything?
Well, probably against anything, but certainly against those two crosses, versus the euro and versus the dollar. I think versus the dollar will go back up if we get if we leave the EU and we have a successful trade agreement, or promise to have a trade agreement down the road. And then if you have the U.S. coming in with some type of a limited trade agreement, Trump's not going to let that go through at 125, 126. He's going to want to see it back closer to purchasing power parity, or the average thereof, which is closer to 140. Right. So, and that's why I see sterling gravitating back towards versus the dollar over the next 6 months.
Interesting. I just want to delve a little bit further into the equities picture. I've just been crunching some numbers here about where we stand at the moment. We're about 1,500 points higher than where we were straight after the Brexit vote. So there's been significant upside since that extreme dismay that was expressed in some sort of an equities picture if there happened to be a hard Brexit. What you've got now in terms of off the highs, about 500 points off the highs that we've had, the 700. So we've made significant headway in some respects back to the position we've now got. So what does that mean in terms of developments to the upside from here, and also the downside? Because it seems like we're more slated towards some form of a positive outcome if you look at that picture. Well,
because the world's got turned on its head. Investors are now buying bonds for capital appreciation and buying equities for yield. And that's not we have to go back to school to get things right in our head. But I think the the fact is the bond market is so heavily distorted that it's actually making equities look quite attractive. And yes, we've had a slowdown in global growth, but it hasn't fallen off we're not in anywhere near a recession. So I think equities and global trade, are justifying today's valuations in equity markets.
The UK is distorted as well, along with everything else.
Yeah, equities versus bonds globally are distorted because of QE and the return to QE. $17 trillion worth of bonds.
It's a nice way of putting
negative.
That people are buying bonds for capital appreciation and equities for yield. Do you buy that?
Yeah, I think it is a nice way of putting it. I mean, we might come to discuss my letter later, but...
I can discuss your letter now. It's called Pride and Prejudice. And actually, what it does, it basically talks about 1813, I think it was her first of her big novels, 2 years before Emma, the one I had painfully had to read for O-level. And you're comparing the characters in Pride and Prejudice with, income appreciation, finding risk-free returns now, aren't you?
Yeah, well, I looked at Mr. Darcy's income, which is reported to be £10,000 in the book, and that would have been
less than modern times, do you know? 800
Well,
grand
£800,000 at least, but actually more than that. I think I come at a much higher figure if you allow for wage buying power then. And saying if that was an annuity, how much would you have had as a capital sum to get that sort of income? And the answer was, thanks to some research from the Bank of England, which goes back to the 1260s, when they look at government bonds or sovereign bonds, the answer was about £260 million then. But to get the same purchasing power now, you would need a gilt portfolio of £2.4 billion. So that's to this point of how
now,
inflated.
Apart from Jeff Cutmore, who else can have that kind of level of bond portfolio?
So you're not buying it for income, are you?
Invested in seriously liquid, high-performing technology names.
Yeah, well, indeed. Could try that.
Mate, so you need that kind of portfolio and purchasing power parity. So that's not going to happen.
It just shows you how, to that very point, that it does not give you income at these levels.
Wow.
And one thing I did mention at the end of the letter was property. It was actually more likely that Mr. Darcy got his wealth from property. Property, you're doing better, actually. You've got a much better shot at that. Agricultural property, which would have been the case there. Although I did calculate that you would need an estate roughly the size of Shropshire to actually get that sort of income.
But again, go back to Mr. Cutmore. But the point is, you advising people to buy ag now?
Buy agricultural property? No. I don't think you have to go that far. I mean, I think commercial real estate actually in the UK, which has been definitely weighed down by Brexit fears, actually does offer pretty good cash flows, pretty secure cash flows with a level of indexation.
Do you think CRE ex retail or CRE come retail? Because I think there's a tragedy happening for high streets and for shopping centres, you name it, up and down the country.
Oh, absolutely.
And I see no sign of abating, and it's got nothing to do with Brexit. It's got all to do with what Karen was just talking about, which is technology. So CRE come or ex retail?
Yeah, well, most of what we've got is ex retail. You've certainly got to mind your eye on retail. I think that hasn't bottomed out, and particularly, the sharp end of it, high street or edge of town retail, I don't think has bottomed out at all. But there are quite a lot of opportunities in areas which are not heavily exposed to retail, or if they are, they're on very long leases to very secure tenants.
Do you have a view on CRE before we go to break?
Well, on property, I suppose I would not want to chase the market at this sort of level. I think the Brexit uncertainty, you don't actually know where companies are going to be basing themselves, in over the next 2 to 3 years. But yes, I agree, the yield is attractive, but it could get more attractive.
So what I've done is, when I'd finished reading Pride and Prejudice, your Precy version, I pulled out their investment notes from Chris and Christopher. Yours I pulled out in one word, which is, kind of very briefly, return of Goldilocks scenario, potentially. Yours, I went through it and I've pulled out the following. Mired in slowdown, little impetus for global upturn, lack of confidence globally, momentum negative start of the year, global growth is deeply pessimistic. Shall I go on? All right. Not much room for error. You're talking about Goldilocks. You just downright pretty miserable, really, weren't they, those comments? Or have I just pulled them out unfairly?
You've pulled them out of context. I mean, our process.
really bad.
You're familiar with our traffic lights, I think.
Yes.
So
I've got the traffic lights.
we look at growth, valuation, momentum, and sentiment.
There's a few. Yeah.
When we look at growth, the problem still of the others, actually, they've got a bit better. So valuation is not so bad. Falling interest rates has helped. So there's a certain case there to be made. Sentiment, when I talk about gloom, that's a positive. The fact that people are gloomy on growth is a positive. So actually, that's why our sentiment traffic light is actually on the green side now. Momentum is uncertain. That's just a neutral for us at the moment. We could be seeing, there are signs of a potential beginning of a new uptrend. We're not discounting that. The problem is growth, and what we've just said consistently is we keep looking down that tunnel, looking for the lights, and they're dim and distant still. We would like to see some signs of improving economic momentum, particularly in the European bloc. If we see that, then our other traffic lights are actually clear the way for us.
And on your potential Goldilocks scenario, thank you for that.
Well, Goldilocks and Three Bears ends very well. So it's an upbeat story.
Well, she breaks the furniture, she ruffles the bed linen, and then she eats the porridge. Who did it go well for?
But they get the right porridge in the end. It's just right at the end. And I think that's really what...
she does.
Yeah.
She nicked it all off those poor bears who had to work very hard. Was she stealing from the
She was seeing...
She was a thief.
Yeah, but she got there in the end. She got there in the end. But I think looking for positives, you've got lower rates. You've got the return to QE. That's going to eventually run its course to the point where I think governments realize saturation point. We've got to move to the fiscal side of the solution. And there's already talk in Germany of changing the balanced budget approach. And I think, I'm starting to feel that the trade deals that continue being negotiated around the world on a medium to long-term basis are positive for global growth, global trade. There's a lot of focus on US, China, but there's other large deals that have been completed or in the process of being completed that will benefit the global economy, and you've already seen central banks move to cut rates again.
We've spoken a little bit about some of the usual suspects in the herding in markets, and I wonder whether we've got another layer of that, because it's been a really important narrative in recent weeks around WeWork and the failure of the company to come to market, and this is obviously a big tech company that hoped to unlock some value and bring in more investors. Then you had Neil Woodford in a fund that has come crashing down because of a lot of illiquid assets that he was invested in, tech names that companies were going to come to market and that investors had hoped to get early access to. So does this mean, with this type of story unfolding around some of the tech and so-called growth stories, as everyone reaches for a return away from negative yields, that we're now back to the same usual suspects on markets because investors might be a little bit shy about those types of investments?
Well, I think certainly people are starting to stretch. I was at a conference the other day, and we were talking about bonds, and the conclusion was, well, we need to start buying COCOs, contingent convertibles.
For a lot of investors.
And I thought, you're kidding me. That can't possibly be the way to get yield into the portfolio. It's certainly people who have forgotten what happened to those types of securities 10 years ago. But
even with Deutsche Bank more recently.
Yeah, but I think investors are starting to stretch. Bond land everywhere. People are going out the curve, down the credit spectrum. In equities, technology it's moving all the time, and you look at the Netflix and the Amazons. They're volatile, and I guess investors who are optimistic are looking for the next one to work. WeWork just is a model that in a global recession, the property valuation of that company runs aground pretty quickly. I think that's the consensus. Not to say that their model won't work, but they need to reduce some of that exposure if there is a global slowdown.
In terms of this underweight government bond story as well, and we've talked about the people buying bonds for capital appreciation, and everything that you gentlemen have said and where the sensible conversations we've had says that this can't go on much longer. We're so far into negative territory. There's 15 to 17 trillion. It's got to end. Is there a trade where one can successfully short government bond paper, go up against central banks in some ways and saying, we think enough is enough, these valuations are ridiculous? Can one do that, or does one just have to take it on the chin and say, it's not a trade we can participate in? Let's start off with you, Chris, and then we'll finish with Christopher.
Well, we are short government bonds in the sense that we hardly own them at all.
So that's
and
not
been the-
what? That's not a short. You haven't gone out and securitized, but gone kind of borrowed the bond and gone
Yeah.
short of it, have you?
No,
So
but
you
we're not.
can't- Well, that's exactly my point.
but we're not a
Can
hedge
one
fund.
short them?
We're not a hedge. You can short them, yeah. You know,
Can
you
our
know,
viewers do
you
it
could-
successfully? I mean,
much harder, much harder. There's probably an ETF out there which does that for you. You know, that wouldn't be something I advocate. I mean, what we want to focus on and being invested in the things which we still think can build an inflation-beating return for you over
But
the
it is
long
interesting.
term.
Sorry,
And there are still opportunities.
but
there.
isn't that amazing that we all think we've all been here for some of us many decades, some of us got their brilliant knowledge in a shorter period of time. But we've been here, we've done it. We think this is nuts. You know, when I started trading German government bonds in the mid-90s in the options pit as well, we were talking about yields up here somewhere. So we've all been on a journey. And yet we can't actually short this product, even though we think it's bonkers valuation.
There are, you can short it. There are ways of shorting it if you want to. I don't think that's necessary. There are ways you can embed a view on this. For instance, I mean, I'll come back to property. Quite a few of those funds which are available have locked in their debt levels at fixed rates, but their rents are index linked, either through open market review, which over the long term you would expect to be geared to nominal GDP growth, or explicitly through inflation linkage. And if we do see inflation, a normalisation of the environment, inflation expectations and inflation itself rise, and they've got fixed debt, so they have locked in these very low rates of interest, then the jaws open up in your favour.
Chris, are you trying to short bond markets?
The way we've got the trade on is we've got a steepening bias we're steepening trade on. So long the front end, short the back end. We think that's, they're going to let
So you
air
look
out
at
of
the
the...
structure of the market rather than the absolute directional trade.
So relative to our benchmark, where we have a steepening bias.
Am I just being disingenuous here and being a bit kind of like white van man about this? If you don't like something, short it in modern 21st century. Or am I just being too...
Well, it's a good job you're not an investment manager, if I say, Steve, because you probably would have put that bet on quite a while ago, and you'd probably be out of business by now.
Which is why I'm a journalist. And I left behind that bet 2 decades ago, and I left behind that business. I've got to leave it there. Gents, thank you very much indeed for that. Christopher, nice to see you. Looking very well as ever. Yep. the Mediterranean agrees with you as well. Or is it the other side of the coast?
Other side.
The other side, Atlantic coast. Christopher Peel, Chief Investment Officer at Tavistock Investments.